If the plan is to invest in dividend stocks and live off the income forever, there are a few things that need to be understood first. In this video, we're going to break down the exact math behind how much needs to be invested to live off dividends, the real numbers for 2026, why chasing a high dividend yield could actually make someone poorer than the alternative strategy, and most importantly, the strategy worth following if dividends are going to be part of a long-term portfolio. Let's start with the math. The math. Let's say the goal is $50,000 per year in passive dividend income. The formula is simple. Desired passive income divided by dividend yield percentage equals amount needed invested. Here's an example. Say the entire portfolio is in Apple stock. At the time of this recording, Apple offers a 0.39% dividend yield. That means for every $100 invested in Apple, 39 cents comes back every year in dividend payments. To generate $50,000 per year at that yield, around 50,000 shares of Apple would be needed, well over $10 million worth of stock. Not exactly realistic for most people. Now, most dividend-paying companies have a much higher yield than Apple. Looking at the Dividend Aristocrats list, these are S&P 500 companies that have raised their dividends every single year for at least 25 consecutive years. There are currently around 69 of them, and their yields typically range between 1 and 4%. Take Pepsi as an example. Pepsi offers a dividend yield of around 3.7 to 3.8%. At that yield, the numbers look very different. To generate $50,000 per year with Apple's 0.39% yield, over $12.5 million would be needed. With Pepsi's 3.8% yield, that drops to around $1.3 million, still a significant amount but a very different target. Looking at a broader table of average yields, most real-world dividend portfolios tend to hover between 2.5% and 3.5%. That means somewhere between $1.4 million and $2 million invested would be needed to generate $50,000 per year. For those targeting $30,000 or $40,000 per year, the number is lower, but it's still a substantial amount of capital either way. Why chasing high yields is dangerous. At this point, the natural question is, why not just buy the stocks with the highest yields and get there faster? This is exactly where things get important. Back in 2022, 3M was considered a rock-solid dividend payer. They were a dividend aristocrat who had raised their dividend every single year for 66 consecutive years. Their yield at the time was over 4%. Then in 2024, 3M cut their dividend. 66 years of consecutive increases gone. Just like that, they were removed from the Dividend Aristocrats list. And they weren't alone. AT&T slashed their dividend by 46% in 2022. Walgreens cut theirs after more than 40 years of consecutive increases. This is exactly why chasing a high dividend yield is dangerous. A company paying an unusually high yield is often a company that can't find a better use for its cash. Or worse, it's a company whose stock price has dropped so much that the yield just looks attractive on paper. Every dollar paid out in dividends is a dollar not being reinvested in the company's own growth. And when a business stops growing, that dividend income can disappear overnight. The reality of dividend investing. According to the Federal Reserve's survey of consumer finances from 2022, the median net worth in America was around $193,000. Adjusted conservatively for inflation, that's roughly $217,000 today. If that entire amount was thrown into a portfolio with a 5% dividend yield, it would generate about $10,850 per year. That's the median person's entire net worth, and it's nowhere near enough to live off of. Getting to $1.5 to $2 million in an investable dividend portfolio is genuinely difficult for most people. And if that's the only strategy from day one, it might actually be making the journey harder. Vanguard published a research paper titled Total Return Investing, an enduring solution for low yields, and its conclusion was clear. Managing a portfolio for total return rather than dividend income alone has several advantages, including better diversification. When a portfolio is concentrated in dividend stocks, it tends to be overweight in defensive sectors like consumer staples, healthcare, and utilities, and underweight in areas like technology and consumer discretionary, which have historically driven significant growth. A backtest on investing.com comparing a Vanguard dividend portfolio against a total market portfolio from 2016 to 2025 showed that the dividend portfolio generated an annual growth rate of 9.43%, while the total market portfolio returned 10.49%, and that 9.43% already includes the dividends. That gap, compounded over decades, represents a meaningful opportunity cost, especially for younger investors, the better approach. So if dividend investing comes with this opportunity cost, what's the smarter strategy? For anyone under the age of 35, it's almost always better to invest for growth rather than dividends. There are three main reasons for this. First, youth means time to recover. Even if the portfolio drops 20 or 30%, there are decades ahead to make it back. Second, most people under 35 simply won't have enough capital invested for dividends to move the needle. A $10,000 portfolio at a 4% yield generates $400 a year. That's not going to change anyone's life. Third, compound interest. The priority at this stage should be building the capital base as fast as possible so that money can start compounding. The bigger the base, the more powerful the compounding becomes over time. For those over 35, especially approaching 40, 50 or beyond, the strategy naturally starts to shift. As retirement gets closer, it makes sense to start introducing more income-generating and defensive assets into the portfolio. In the late 30s, maybe 5 to 10% gets allocated toward dividend-paying ETFs. In the 40s and 50s, that could move up to 15, 20, or even 40 to 50%, depending on individual goals and risk tolerance. The core of the portfolio can still be growth-focused, but a meaningful slice generating dividend income becomes more and more relevant as retirement approaches. One more thing worth noting, especially in 2026, a dividend yield of around 3% is now very comparable to what's available in a high-yield savings account or a treasury bond. For anyone seeking income right now, those are real alternatives that don't require stock market exposure at all. Treasury bills in particular carry very low risk compared to dividend stocks. The interest rate environment changes over time, and it's worth taking advantage of whatever options are available at the moment of investing. The takeaway. Here's the formula to take away from this video. Dividend income needed divided by dividend yield percentage equals amount needed invested. So if the target is $40,000 per year in passive income and the portfolio yields 5%, that's $40,000 divided by 0.05, which equals $800,000 needed. But for anyone investing long term, especially on the younger side, growth should be prioritized over dividend income. Build the capital base first, let it compound, then gradually introduce dividend-paying assets as retirement approaches. Dividends are not a bad strategy, but they work best as part of a bigger picture, not as the only plan from day one. If this was helpful, make sure to like and subscribe for more investing content. See you in the next video.